Welcome everyone, it's great to have you with us today. Now, some of you may have joined me before on previous webinars, but for those of you meeting me for the first time, I'm Chris Ashton, the head mentor at the Corellian Academy. This webinar is the final installment in a 5-part series where we've been exploring how to use technical analysis to trade CFDs more effectively on the Plus500 platform. If you have missed any of these earlier sessions or you want to revisit them, you'll find a link in the Zoom chat that takes you straight to the Plus500 YouTube channel. There you can catch up on these technical analysis sessions along with our other webinars covering specific markets like oil, gold, and major US indices. Now, regarding this specific series, each individual webinar focuses on a different topic, so you don't need to have joined us on the previous 4 webinars to learn something new today that may help to support your trading. Before we dive in, just a couple of quick housekeeping notes. Today's session will run for around 20 minutes. We'll finish with a Q&A, and I'm joined by Richard Adcock, who's Corellian's technical analysis mentor. So feel free to drop your questions for myself or for Richard into the Zoom chat or the Q&A box anytime. And please note that trading CFDs carries risk, and everything we cover today is purely for educational purposes. It's not financial advice. Okay, let's get started. Now, in today's session, we're diving into one of the most misunderstood areas of technical analysis, and that's overbought and oversold conditions. Many traders see these readings and immediately assume a reversal is just around the corner. But as most of you will know from experience, the markets don't always play along. In fact, they often do the exact opposite. I'm sure many of us have been there when you spot what looks like a classic overbought or oversold level on a CFD chart. You take a position against the prevailing trend, expecting at least a pullback, maybe even a full reversal. And then nothing. The price just keeps driving in the same direction, as if the indicator wasn't even on the chart. Today, we're going to unpack why that happens, when these signals genuinely matter, and when they can lead you astray. By the end of this session, the plan is for you to have a much clearer sense of how to use these tools with confidence rather than relying on them blindly. So why focus on this topic today? Because when the market ignores overbought or oversold readings, something very important is happening. It can mean the trend has far more strength behind it than traders expect, and that strength can push prices much further than traditional indicators might suggest. And if we step back for a moment, that's exactly the kind of behavior that can create some of the biggest opportunities. The goal today is to identify the technical tools that help us recognize those moments when overbought or oversold readings are likely to be ignored, when they're likely to be respected, and how to distinguish between the two in real time. If we can do that, we not only avoid the frustration of fighting a strong trend, we may also put ourselves in a much better position to benefit from markets that are trending cleanly and sustainably. Now, here's what we'll cover in the next 20 minutes. We'll start by breaking down overbought and oversold price readings, what they mean and how they can influence price behavior in real time. From there, we'll explore the technical indicators most traders rely on to identify these conditions. We'll look at their strengths, their limitations, and why they sometimes send signals that the market simply doesn't respect. And then we'll take things a step further. We'll look at how combining the indicators rather than relying on a single reading can help us understand when overbought or oversold readings are likely to be ignored and when they're more reliable. This is where we start turning theory into something you can apply within a trading strategy. And finally, we'll bring everything together by looking at a case study of the recent Nasdaq 100 price action, where we'll examine how traditional overbought readings have behaved during the latest surge and which additional techniques could have helped traders navigate that strength more effectively. So, what exactly do we mean when we say overbought or oversold readings? These readings come from a range of technical indicators that react to extended moves in the price of a CFD. After a strong rally, an indicator may flag the market as overbought. After a prolonged decline, it may highlight oversold conditions. Now, here's where many traders, especially those who are newer to technical analysis, may run into trouble. There's a common misconception that these readings act as automatic reversal signals. The thinking often goes something like this. If it's overbought, then the price must fall. And if it's oversold, then the price must rise. But that simply isn't how markets behave. An overbought reading doesn't mean the market has run out of buyers, and an oversold reading doesn't mean that sellers have just disappeared. In fact, some of the strongest, cleanest trends in financial markets occur while indicators remain overbought or oversold for extended periods. Understanding this distinction is crucial, and it's exactly why we're unpacking this topic today. Okay, so why does this matter? If you simply sell every time you see an overbought signal, or buy every time you see an oversold signal, your trading results are likely to not only be inconsistent, but often frustrating and ultimately expensive. So then why use these overbought or oversold readings at all? Well, because in the right circumstances, they can be extremely useful. The key is understanding how to interpret them and when they genuinely add value. Used correctly, they can help you time entries into trades, manage risk, and avoid getting caught on the wrong side of a strong trend. So moving forward, what technical indicators are traditionally used to highlight overbought and oversold conditions? The tools that generate these signals are known as momentum indicators. Their job is to measure the speed of a price move, basically how quickly a CFD is rising or it's falling. When that speed reaches unusually high levels, the indicator may flag the market as overbought. And when the speed drops to unusually low levels, it may highlight oversold conditions. At these extremes, the risk of a shift in the recent trend direction does increase. There are many momentum-based indicators out there, but today we're going to focus on the two that are most widely used. The first is the Relative Strength Index, or the RSI for short, and the second is the Stochastic Oscillator. Both are popular because they're simple to read and widely available on trading platforms. Now, we won't go into the full mathematical formulas behind them because that would take far longer than we have today. But we will look at the types of signals they generate and how you can use those signals effectively in your day-to-day trading. So first, let's look at the RSI indicator. This is a momentum-based oscillator designed to measure the speed and strength of recent CFD price moves. It runs on a scale from 0 to 100, and traditionally, readings above 70 are considered overbought, and readings below 30 are considered oversold. One of the reasons the RSI is so widely used is its versatility. You can apply it to any asset class: stocks, bonds, commodities, FX, indices, and of course, all of these are CFDs. And it works across all timeframes, from long-term charts to intraday trading. But we've been talking a lot about overbought and oversold conditions. Let's talk about what this means in terms of practice. Well, what this really tells us is that prices have traveled a long way in one direction. If that move has been to the upside, the market may be entering overbought territory, a point where many of the traders who wanted to may have already done so. When that buying enthusiasm starts to fade, or when it no longer outweighs the selling pressure coming into the market, price often begins to weaken. That pullback, that easing of upward momentum, is what we call unwinding overbought conditions. On the other hand, if the move has been sharply to the downside, we may be dealing with oversold conditions. In this scenario, most of the traders who wanted to sell have already sold. Once that selling pressure begins to ease, or buyers start stepping back in to the market, we often see a recovery as those oversold readings unwind. The RSI is designed to help us identify these extremes. It highlights when momentum is stretched too far in one direction and when the risks are beginning to shift towards corrections from overbought levels or recoveries from oversold levels. Understanding these dynamics is essential, not because they guarantee reversals, but because they help us recognize when the balance of pressure in the market may be starting to change. If we look at the daily chart of the UK 100 index between April and mid-November 2025, and then add the RSI to the chart, we can really see this indicator in action. On the Plus500 platform, the default setting is a 14-period RSI, which is the standard configuration. You can experiment with different settings to suit your own trading style, but for today, we'll still stick with the default. As a reminder, the RSI uses a scale from 0 to 100. Readings above 70 are traditionally viewed as overbought, and readings below 30 are traditionally viewed as oversold. And you'll see those levels marked on the chart. Now, it's important to stress something here. This is not an exact science. Just because the RSI moves above 70 or moves below 30 does not guarantee a reversal. These levels simply highlight that price is stretched far in one direction and may be vulnerable to a pause or to a correction. In practical terms, these extremes act as a heads up. If you're thinking about buying this UK 100, but the RSI is above 70, you might wait. You might decide to wait because the market is seen as overbought, and a short-term correction could offer a better entry level for your trade. And when we look at the chart on screen now, you'll notice that each time the RSI pushed above 70, a sell-off followed. Those overbought readings did lead to corrections. But here's the key observation. During the entire May to November advance, the RSI never once reached oversold territory. The only oversold reading on this chart occurred way back in April. And this highlights one of the challenges with momentum indicators in strong trending markets. In an uptrend, it only takes a small dip in price for buyers to step back in. And in a downtrend, it only takes a modest rally for sellers to reappear. The indicator rarely reaches the traditional extremes. That's why understanding the trend context is essential, because this can shift perceived oversold readings in an uptrend to higher levels and perceived overbought conditions lower in a downtrend. In a strong uptrend, what looks oversold on the RSI might occur at a much higher level, sometimes as high as 55, as we can see on the UK 100 chart. These higher than expected oversold readings often align with points where the trend resumes. And we'll explore this idea of trend adjusted signals in more detail shortly. But for now, here are the key takeaways when you're using the RSI. Feel free to take a screenshot of them for future reference. Okay, let's move on to another key momentum indicator, and that's known as the stochastics. The stochastic oscillator is another momentum tool. And like the RSI, it helps traders identify potential overbought and oversold conditions. But it does this in a slightly different way. Where the RSI measures the speed of price movement, stochastics compares the current closing price to the recent high-low range. In other words, it tells us where the latest close sits relative to the extremes of the last X periods, which are typically 14, which is also the default setting on your Plus500 charts. Like the RSI, it moves between a range of 0 and 100. Traditionally, readings above 75 or 80 suggest potential overbought conditions, and readings below 20 to 25 suggest potential oversold conditions. The indicator itself is made up of two lines: the percentage K, which is the main stochastic value, showing where the current close sits within the recent range, and the percentage D, a 3-period moving average of the percentage K used to smooth the signal. Now, traders use stochastics in several ways: crossovers between the percentage K and percentage D lines, divergences between price and the indicator, and of course, whether the indicator is sitting in overbought or oversold zones. Now, let's apply the stochastic to the UK 100 index over the same April to November period. Just like before, we've added horizontal lines at 80 and 20 to mark the traditional overbought and oversold zones. Where the percentage K line crosses above the percentage D line while the indicator is in oversold territory, that's typically seen as a bullish signal. When percentage K line crosses below the percentage D line while above 80, that's usually interpreted as bearish. But, and this is the important part, when we look at the chart, we see the same issues we saw with the RSI. Overbought and oversold readings are not consistent. Their reliability depends heavily on the trending condition of the CFD. In the UK 100 example, we're clearly in an uptrend, and within that environment, the stochastic doesn't always reach oversold levels before price turns higher again. Overbought readings don't always lead to meaningful declines, and the indicator can remain overbought or oversold for extended periods. This behavior reflects market sentiment. In a strong uptrend, traders are bullish. They're willing to buy at higher prices, and it only takes a small dip for them to step back in and buy. In a strong downtrend, the opposite is true. Only when sentiment genuinely shifts do we start to see deeper corrections and more traditional oversold readings. So the key point here is this. In a strong trend, overbought is not necessarily bearish and oversold is not necessarily bullish. To know when to trust these signals, you must understand the trend backdrop. And that's where combining momentum indicators with trend indicators becomes incredibly useful. Now, before we move on to that, let's look at how momentum indicators behave in sideways markets, because this is where they really shine. For this example, let's take the Germany 40 index between May and November. During this period, prices traded in a clear range between the June 19th low and the July 10th high, with support and resistance holding each time they were tested. When we add the stochastic indicator, the picture becomes very clear. Overbought readings aligned with turning points at the top of the range, and oversold readings aligned with turning points at the bottom of the range. The RSI showed similar behavior. So the conclusion is straightforward. In sideways, range-bound markets, momentum indicators like stochastics and the RSI work extremely well. They can help you identify potential turning points and trade the range more effectively. Now, that wraps up the section on stochastics. As before, here are the key takeaways from this section, so feel free to screenshot them for later use. Okay, so now we've explored momentum indicators and how they behave in different market environments, and we've seen just how important it is to understand the underlying trend if you want to get the most out of those signals. In previous webinars, we've looked at several trend-based indicators, but my personal favorite and the one that I rely on the most is Bollinger Bands. If you haven't watched a webinar dedicated to Bollinger Bands, it's worth checking it out on the Plus500 YouTube channel. But here's a very, very quick refresher. Now, the mid-average, or the Bollinger mid-average, shows the direction of the trend. A rising mid-average shows an uptrend, and a falling mid-average shows a downtrend. The upper and lower, or the outer bands, measure volatility. If the bands are running parallel, that highlights a steady trend, up, down, or sideways. If the bands are converging, that suggests that volatility is falling and that consolidation is likely. And if the bands are widening, volatility is increasing in the direction of the trend that is indicated by that mid-average, often signaling a strong and stable trend. Now, for today's session, I want to combine Bollinger Bands with the stochastic indicator in a case study of recent moves for the Nasdaq 100 index. Why the stochastics? Because, well, the percentage K and the percentage D crossovers give a very clear signal of directional change. And that works beautifully when we're trying to time entries within a trend. Let's look at a recent example of this Nasdaq 100 index with both the stochastics and Bollinger Bands applied. By combining a momentum indicator with trend indicator, we add a whole new dimension to how we interpret the signals. We already know that in an uptrend, oversold readings are rare and overbought readings are unreliable. And in a downtrend, we also know that overbought readings are rare and oversold readings are unreliable. So instead of fighting that trend, let's flip the logic. What if we ignore overbought readings in an uptrend and ignore oversold readings in a downtrend? Because we know those signals are the least reliable. Instead, we let Bollinger Bands define the trend. The mid-average rising is an uptrend. The mid-average rising with bands widening is a strong uptrend. The mid-average falling is a downtrend. The mid-average falling with bands widening is a strong downtrend. Once we know the trend, we use stochastics only for timing. In an uptrend, we only care about the stochastics crossing up. And in a downtrend, we only care about the stochastics crossing down. That's it. No guessing, no worrying about whether an overbought or oversold reading should work. We're simply aligning momentum with the prevailing trend. When we look at the Nasdaq 100 chart, Every time the stochastics crossed higher within an uptrend, momentum turned up in the direction of the existing trend and price followed through. In a downtrend, the opposite would apply. Stochastics crossing lower would signal momentum turning down in line with the broader move. Why this combination works? Well, by pairing Bollinger Bands with stochastics, we avoid the classic trap of relying on overbought, oversold readings in strong trends. Instead, we get clear trend direction, clear volatility context, and clear momentum timing signals. This helps us identify when corrections are ending and when the trend is likely to resume. Of course, no indicator is perfect, and you should always consider placing stop losses to protect your risk as soon as you enter a trade. And once you have defined your loss limits, it's worth considering your upside, as these profit orders can also be placed in advance on the Plus500 platform. Remember, unexpected events can spike volatility and reverse price direction quickly. Okay, that brings us to the end of the presentation section of today's webinar. I can already see several questions coming in, so let's bring in Richard and start working through them together.